Tax season is here again, and for many Canadians, it's another year of wondering, am I really doing enough for my future? We work hard, we save, and hopefully invest when we can. But what if there was a way to do more with what you already have or expect to have? A way to stretch every dollar and put your money to work for you right now without sacrificing your cash flow. That's exactly what the Registered Retirement Savings Plan Gross Up Tax Strategy can do. It's a game changer that can supercharge your retirement savings if you know about it and you put it to work for you. Let's explore how the Registered Retirement Savings Plan Gross Up Tax Strategy works. If you've already contributed to your Registered Retirement Savings Plan and are expecting an income tax refund, you can use that future refund right now to contribute even more before the deadline. Instead of waiting for the refund, you temporarily increase your contribution using cash or a short-term credit line if you don't otherwise have cash available. When your income tax refund ultimately arrives, it reimburses this extra contribution amount, effectively boosting your registered retirement savings plan balance immediately without affecting your long-term cash flow. Recognizing that this is a complicated topic, let's break it down using rounded numbers for illustration purposes. Imagine that you've been putting away about $1,000 every month throughout 2024, $12,000 in total. With an assumed marginal personal tax rate of 44%, you would expect to generate an income tax refund of about $5,000, or $12,000 multiplied by the marginal tax rate of 44%. Now, in order to supercharge your registered retirement savings plan now in February, instead of waiting for that income tax refund of $5,000 to arrive to invest, you would actually contribute even more before the deadline, in this case, about $9,000, using available cash or a short-term credit line, again, if you don't have the cash available. Now, what does this do? Well, more contributions means more income tax refunds. That extra contribution of $9,000 generates an additional refund of nearly $4,000. So that's calculated as $9,000 times your marginal tax rate of 44%. So you've got an extra refund of nearly $4,000, which further replenishes your cash flow. If you're doing the math and you're following it, that refund covers the extra contribution. Your total refund of $9,000 now matches the extra contribution, meaning you've significantly increased your registered retirement savings plan balance without additional long-term out-of-pocket costs. In essence, you've gotten the benefit of the tax deduction in this tax year rather than waiting to get the benefit next year. Now, why is this strategy so powerful? Well, it means that there's more money growing sooner. If you did nothing in our scenario, you would have had $5,000 as an income tax refund, which you could have used to invest. Instead, you now have $9,000 working for you immediately, giving your savings a major boost. This is nearly 80% more with no long-term change in cash flow. More money in your registered retirement savings plan now hopefully means greater compounding potential, translating into substantial long-term gains. Your tax refund again covers the extra contribution, so you're not permanently out of pocket. There's really no long-term cash flow impact. Now, there are some key considerations that you do have to consider before jumping in. First is, do you have the cash flow to actually employ this strategy? Even though the refund that you expect, the increased refund, will cover the additional contribution, you do still need funds now to make that additional contribution. Again, either some extra cash or a credit line in place if you don't have that extra cash. The CRA also has some considerations here. Refunds, as you know, are not instant. If there are delays for any reason in processing your income tax return and you're receiving your refund, you may need a backup plan for covering any temporary shortfall. Again, it's a temporary shortfall because your refund actually covers the contribution. You would also want to make sure that you're being aware and checking your contribution limits. Exceeding your registered retirement savings plan room can result in penalties, so it's always best to check before contributing more. There's also, of course, market uncertainty. Investing earlier means more growth potential, but short-term market swings can impact returns. From an overall final thought perspective, though, your future self will thank you for knowing about this and potentially employing this strategy. Imagine a future where money isn't a worry, where your investments have grown so significantly that you can travel, support loved ones, and live a comfortable life. That future starts now. When you're utilizing a registered retirement savings plan for retirement savings, this gross up strategy is a smart, powerful way to accelerate your wealth. When used consistently, it can help build a significantly larger retirement refund than you ever imagined. Year over year over year, this extra compounding could result in hundreds of extra thousands of dollars with, again, no long-term change to your cash flow. But financial strategies like this do require careful planning, and you shouldn't go at it alone. Your advisors are there to help you in terms of structuring and carrying out strategies like this. And at Compass CPA, we are here to help empower you with knowledge to set yourself up for a lifelong financial security. Again, recognizing that this is a complicated topic to follow, we will have a more detailed article on this strategy for you to work through your own numbers yourself. And as always, if you enjoy our content, please like, follow, and share.